Welcome to part 2 of tonight's Opportunity Zone Meetup. My name is Karl Dakin, and I'm the host of tonight's program. Our topic for tonight is setting capital goals, and this is in the framework of running an Opportunity Zone capital campaign for any kind of project, whether it's a business, a property development, or a community project. It's important to be able to determine how much capital you really need in order for you to clearly and correctly communicate this to investors. And we're going to walk through the first part of this, which is a capital needs assessment. So as we start off, and I was making this point earlier and again last night, raising capital is not magical. The fact that people approach it that way, they act like it's a magical thing, they seem surprised when the money shows up. They typically should be surprised that any money showed up because they are not thinking through the process. And so I have a 10-step process that we're going to be, I use with my clients, and we're going to be using in the Colorado Center for Innovation and Community Capital, which is rational, logical, to try to match you with people who care about what you're doing, who will benefit from what you're doing, and who are interested in making their capital available to you in some form so that you can do what you want to do. But too often, we today have kind of, as a culture, an entrepreneurial myth, have come up with this concept of the white knight, the angel investor, who will appear suddenly out of nowhere and throw money at you with no explanation, with no due diligence, with no justification, because you need the money. And it doesn't work that way. And when you watch TV where it's been put into an entertainment mode, you still get this sense, well, it's just an instantaneous kind of a thing. They didn't need to form a relationship. Nobody had to have a trust or credibility involved. It just doesn't work that way. And so I regularly get people coming to me and said, I want to raise money, and we talk about it, and then they go, tell me who to talk to. Like, you know, just point them out, and you'll be done. And it happened again this week with a couple of conversations, and I'm like, so you didn't listen to the rest of our conversation, or you're still drinking the Kool-Aid from watching Shark Tank or some other program that has nothing to do with reality. And yeah, but that's what we kind of teach entrepreneurs, and unfortunately all these pitch competitions have seemed to enhance this expectation that there's a long list of people just want to give you money, and I'm forgetting that you're competing for the money, and that most people don't care anything at all about what you're doing if they're an angel investor, unless something within what you're doing impacts them directly, and that's probably not going to happen. So 98% of all angel pitches are rejections. Statistically, only 2% of angel pitches get funded, and yet this is the norm in the capital industry, which is the reason why small businesses, particularly startups, or anybody doing anything new, is highly frustrated in doing a capital campaign. So we're going to get away from magic, we're going to get into logic. So there's no magic in the world because logic has killed it. That's a theme for many stories, but we'll get into that. So it's a process. It requires time. It won't happen instantaneously. General premise is no one makes an investment in someone they don't know. So why you would ever think somebody would write you a check tomorrow when they just met you doesn't make any sense. It takes an investment in raising money in order to raise the money. So there is not only the price of money when you raise money, but there's a cost of raising the money that has to be factored into your total cost of money. And too often, small businesses don't have the time and can't afford to do a lot of the things they need to do. And then we get to knowledge. Raising money in an opportunity zone, unfortunately, is more complicated than raising money through a standard angel pitch process because of the timing on when money has to be raised and deployed, and dealing with the capital gain rollovers, which narrows the number of people who can qualify to make an investment. You automatically have just 2 or 3 more pieces that make something that's already hard that much harder. And so we're seeing a lot of people who could benefit from opportunity zones kind of backing off from it because they're saying, it's too much. So we're going to see what we can do here to make this simplified, make it straightforward, rational approach. And this all leads to success in the campaign. There really is no winner if a business goes out to raise money and they don't raise the money. Now, unfortunately, a lot of times you'll see in the press and you'll see a number of commentators take the position, well, they didn't raise money because they weren't worth it. Okay, they weren't a good business, they weren't a good investment. And that's not true. What we've seen, and we will also admit, we've never seen a perfect business. They always have something that needs to be fixed or improved or something that's missing. But in most cases, that can be fixed. It may take some while, it may take a lot of work to fix it, but it's fixable. And then the business becomes investment worthy at that point. There are businesses that may be fundable, but we wouldn't touch because we think the motivations of the principals are bad, or they're too inexperienced, or they don't understand reality to the point where you would want to trust them with your money. But those actually are a small percentage of all the businesses out there. The biggest challenges most businesses have is they just don't make enough money to be highly attractive. Somebody wants a great rate of return. They don't make enough money to do that. So we have to come up with more efficient systems that can get the right money at lower cost into their hands. And this is the part of that process. So we're going to talk about what is a capital goal. So when you do a capital campaign, you'll be asked, well, how much money are you trying to raise? That dollar amount is a capital goal. And it's something that's going to show up in your offering documents when you promote what you're doing. It's something that people are going to think about in terms of, is that money the right amount relative to your business, relative to your age? It's a piece of information that has to go into the filings with the government agencies at some point. So we just filed the Reg D filing on Edgar this week for our capital campaign. And this is, what's the maximum amount you're going to raise? That's my capital goal, $600,000. So that has to go into the form, and you need to know what it is. The question then becomes, what does a capital goal really represent? It's not just a number, it's there for a reason. So what we have found, again, is too often businesses go, well, I need this amount of money. We're now taking applications for businesses to receive the support of the Colorado Center for Innovation and Community Capital. I'll keep saying that faster till it's all blur. But they'll say, well, we need so much money. And sometimes you look at it and go, that makes sense. I can see that. A lot of times you go, I have no idea where that number came from. The first blush is that they don't know what they're talking about, or they mislabeled it, or something doesn't make any sense. And anytime there's that pushback as the observer, the potential investor, you're losing credibility. And you don't get any slack in this area, because you lose any credibility at all, they're likely to go talk to somebody else. So you got to think through this process. It is intentional, and we're going to get into that. So the first thing you do in determining what a capital goal is you want to determine what your true capital needs are. And this is broken out by milestones. So as you look at your long-term goal for the business, along the path there will be things that represent accomplishments or achievements which are important to the outside observer, again, saying they've done something important. They're a little more mature. They're a little less risky. And these are milestones. And then what we're talking about is what kind of capital, how much capital do you need to get to each of these milestones? Because this is going to help frame how much capital you really need, how much is going to become part of your capital goal. So in this case, I've pulled just a few examples of milestones that are commonly used. One is, when does the business become profitable? Okay, and that's actually further down the road than the first one, using a thermometer approach, a progression. When is the product ready for sale? When is the service ready to go to market? Some businesses, and we were talking earlier that the new proposed rules for opportunity zones are now allowing time that might be dedicated for product development, for research and development, testing, certification, other things along that line that a business may need to go through before it can ever actually enter into its intended purpose, which is selling that product or service. And this is common in a pharmaceutical or a number of products that may impact safety or something along that line. So we have complete the product. First milestone. Next one, open an office. Now, in today's day of the internet, you may or may not have a formal office, but you have a web address, and you may have a mailing address and a phone number. You have an office. We get to the first sale, product or service, something other than to your cousin, nephew, or somebody who knows you too well. This would be what we call a true third-party sale that represents the market likes what you're selling, is willing to pay you for it. That's a major accomplishment. I have a list of about 45 of these that we may be using in our evaluation of businesses that run the range going forward all the way out to 10 years, because we're now working with a 10-year cycle. And I can tell you almost absolutely every company we've talked to is not thinking beyond 5 years, because no one else does. So when you ask them where you're going to be in 10 years, they go, in 5 years, this is where we want to be. But we haven't gone that far yet. And now we're saying, but your exit for an opportunity zone investment is at the end of 10 years. So you need to know where you're going to be at in 10 years so you can tell your investors what kind of exit it's going to be, what kind of return you might hit if you hit your assumptions, all that kind of information, because they are concerned and they will ask you about the exit, because that's where they get their money back. And they'd like to know when, how, where, and how much that's likely to be. So you need milestones going all the way out to 10 years, and then any significant point along that path is something that you want to look at. Then you're trying to figure out, what is an investor going to be willing to pay as you move through these milestones, because they are viewed differently. You're going to ask yourself, what kind of capital do I need to get to each of those milestones? And there are different forms of capital, and one of the points I always make to people is too often, almost always, people talk in terms of cash. You're going to raise capital? Well, I need $3 million. Okay, but what are you going to spend the $3 million on? Well, I'm going to get people, I'm going to get equipment, I'm going to get buildings, I'm going to get different kinds of assets. This shows up in an offering document. It's what's called a use of proceeds. They want to know, yeah, if I give you the money, what are you going to spend it on? It also reflects how you're going to do your business, how you're spending your money. One of the questions in the Reg D filing is how much of the money you're raising is going to be spent on people who are on the management team. It's a single question that's there, because if the ratio is too high, it's a flag for somebody to start going, I wonder if this is a real business or this is a questionable capital raise. So you need to know what the money is going to be spent on, and now we're going to try to cross these two together. So I created a very simple matrix for tonight's presentation where I've got 4 milestones that I mentioned before. I have 3 types of capital that I may need in order to successfully reach the milestones, and put them in a matrix so I can look at this. So to complete product development, I'm going to need some cash. There's no avoiding that. There are certain things that I can't do without cash. I'm going to need some people, obviously in R&D, maybe some market feedback, those kinds of people. I have operations, management, and I probably need some equipment to make all this stuff happen. So I need 3 types of capital to achieve this particular milestone. But to open an office, I can do that with a check. It doesn't involve people, doesn't involve equipment, unless I'm going to hire a broker or I'm going to need somebody like that as a contractor come aboard. In some cases, that is necessary. We go down to complete first sale. I need cash and people. To become profitable, I'm back to I need cash, people, and equipment. So for every milestone, I'm now mapping out what kind of capital I need. And this is still a very high level, but as you can imagine, if we take this to a high degree of sophistication, 10-year cycle, I might have 20, 30, 40, 50 milestones, and I may be breaking this out into 20, 30, 40, 50 types of capital for doing each of those. And I need to get specific. I need a specification for each type of capital. The reason for that is there's a lot of variation in a theme. on the types of capital that are out there. And think of yourself, this is the easy way to think about this. You're going to go to the grocery store. You were just asked to go get all the ingredients to bake a cake. And you're going, okay, I need flour. Well, is it whole wheat? Is it enriched? Is it white? Is it this? Is it gluten-free? You know, what are we working with? And that's important because in the formula for your business, in the ingredients for baking your business to where you want it to go, you're going to say, I need all these different things. Do I have them already, or do I need to go get them? And this is important because we're going to ask where we're going to get those in a moment. But you need to put together your shopping list. And so at this point, I'm going to take some questions on this. So I'm going to go back to the last slide. But the needs assessment is simply saying, I'm going to create a brand new business. Every business is unique. I don't care if it's a dry cleaner and a dry cleaner. This one's in this location with this traffic, with this market. This one started 3 years ago. This one started 6 weeks ago. They are different, even though they're dry cleaners. This one may require this type of equipment's being used in the back room. This one may be doing other types of equipment, which means my personnel need to be trained differently. This one may be a high volume. This may be a local mom and pop, different. As you're doing capital campaigns, the campaign has to be a reflection of the business. It has to be able to understand that business well enough to know what resources are necessary for success. And then you're going to go through this in the next few stages here, and we're going to get more detailed, more specific, and we're going to be working towards an outcome where we can say, here's what I need to do, here's why I need to do it. If somebody asks you a question in an interview, you can go, oh, I'm going to buy a .34 Epson printer with a photo printer capability, which I didn't do last time, and because I need to print material for promotional purposes, and I can't do it on the .31 version. And they're going, oh, okay, the person knows their business, knows the detail. There's not something that's being handed off to someone. I feel comfortable entrusting them with my money because I think they're into their business. So any questions on doing needs assessment? Anybody want to volunteer their business, and we can do a real quick snap analysis? Okay, thank you all for your yes, go ahead, Trace.
Wait, what am I doing?
So you have a company that provides financing services by factoring accounts receivable.
Right, raising capital.
And as we talked about earlier this week, you're not financing purchase orders, you're financing receivables.
Right.
So as a business, we would be asking you first, what are your milestones going out over the next 10 years? Where do you want to be? What is that vision? Because investors are not actually, they're investing today, but they're investing in where you're going to be 10 years from now. I sometimes refer to investing as a time machine where you get into it and you step out 10 years and you go, where are you? And you're going, well, hopefully I'm in a successful surrounding with a very thriving business and good, happy employees and profitable and all those kinds of things. What do you need to do to get there? So what would be some of the milestones that you would encounter along your 10-year path?
Well, so we're very cash heavy, so we would, you know, in over a 10-year timeline, like to have about a total of $10 million out on the streets, and that would require about really about one person per million. That's kind of like the rule. You have to have a little bit more sophisticated software to handle that type of volume of.
A little more automation, a little less Excel spreadsheet.
Yeah, exactly, and also, you know, the ability to monitor debtor activity and their changes in payment behaviors, so that you can get ahead of the risk management piece of it.
Flags going out,
Yep.
so that if they late or miss a payment, then you should check in to make sure that it's not at risk, because you want to limit your downside if there's a problem and take some appropriate action.
Right.
So roughly 10 people, and so how many managers would you need to sit over the 10 people?
Probably just need one manager.
Okay.
And that would be their sole job, and maybe 2 to 3 salespeople.
Okay.
It would just be deployed in strategic areas, industrial areas, things like that. So we can cover a region.
How many offices would you need?
Actually, just do one office.
Still one office. Okay.
Yeah.
How many cars? 5 your own. It's okay. No,
Yeah.
but that's part of the process.
Yeah.
You can see where I'm going to start asking these kinds of questions, because when you start asking me for a check, I'm wanting to find out if you bought them all a new Ferrari, or you told them to use Uber all the time. And
Yeah.
I'm going to give you points on the Uber side of the
Yeah.
answer, but not on the Ferrari side.
Yeah. So we'd go with the Honda Civic. Get a lot of miles out of those.
Yeah, and so what you're doing is you're starting to make your milestone list. You're going to talk about stages of growth, and you're going to go along this path, and you're saying, I'm going to need these things. And so when you're raising money, you're saying, well, how much do I need to bring from outside, not something you can generate internally or you didn't bring yourself to the table. And you're going to be doing this analysis continuously, because it's not a precise science, and it's changing all the time. But by having these kinds of information, you can start making decisions. And when you start talking about framing a capital campaign and going, I'm going to have to invest my time and my money and put my company a little bit at risk by being distracted while I'm raising money from what I should be doing or what my core business is, what's a reasonable amount of time to invest? What's a reasonable amount of money to invest? All these things come into play, and we're now looking at this in that larger context. Anybody else want to go through a SNAP analysis? Okay, but you can see where we're going is we're saying, instead of pulling a number out of the air and then trying to defend it to an investor, and we're going to talk more about why good, bad, and indifferent on high, low on that, is we're starting to build an understanding of our business. We're trying to do it from the context of the perception of the investor. Why do you need my money? What are you going to do with it? Because they expect you to give it back to them with more money left over. And if they see that you're running a thin program or you're spending money loosely or something, they're going to start getting twitchy about whether or not they're going to make that money available to you. Whereas if you have this level of detail and understand your business, that's all good. We've been talking about some businesses on the brakes and so forth where everything's changing. And if you cannot talk at a level of, I know where the changes are and what's happening, maybe you shouldn't be in this business, and again, you're losing credibility. So let's take a break.